Okay, good evening, everybody. Welcome to tonight's SCORE workshop, Understanding Financial Statements. My name is Jerry Smith. I'm a SCORE volunteer. I'm also the workshop team leader for the Piedmont chapter. I'll be monitoring the chat and the Q&A windows tonight. So if you guys have any questions throughout the webinar, go ahead and put those in there, and I'll try to get to those and get opportune time for Rich to pause and to get to any questions you may have. For those of you that may not be familiar with SCORE, we're a nonprofit organization, resource partner of the SBA, and we're 100% volunteer-based. SCORE basically has two main areas that we focus on. The first is one-on-one mentoring. We provide experienced business owners and executives to work with small businesses and help them in various different ways on a one-on-one basis. And the other area that we focus on is sort of what we're doing tonight, which are educational workshops. And really the bottom line message is that SCORE is here to help local small business in any way that we can. And if you'd like some more information, please go ahead and check out our website at piedmont.score.org. And from there, you can click on a link if you're looking to sign up for one-on-one mentoring. And also where you found this, which is probably on the Take a Workshop link, you can see other upcoming workshops that are going to be coming our way in the over the next month or so. So at this point, I'd like to introduce our presenter, Rich Cleys. Rich is a retired CFO and a well-known small business educator and financial consultant. He's not only a SCORE subject matter expert, but also a frequent contributor to educational programs organized by the Greenville Chamber, SBDC, and other local organizations. So I hope everybody's looking forward to learning a little bit more about financial statements tonight. And at this time, I'm going to turn it over to Rich.
Thanks, Jerry. As Jerry said, he'll be monitoring the chat. So if you have questions, go ahead and put them in the chat, and I'll break at certain times to view those questions. And also, Jerry may interrupt if there's something that's urgent. Tonight's presentation, Understanding Your Financial Statements, is meant for those people who are not accountants. It's for those entrepreneurs that are running businesses or in decision-making positions that don't necessarily have an accounting or bookkeeping background. So what we're going to do is give you some basics on what financial statements are, and then focus on some of the tools that you can use to analyze the results of your statements with a view towards focusing on the areas that need improvement. Okay, hang on. There we go. All right. So Jerry mentioned SCORE is volunteers. There's the primary SCORE website. We offer free mentoring on one-on-one, also email. Here's some of the background on me with an email address and phone number if you should need, if you have any questions after this presentation. All right, let's get into it. So accounting methods. There are two methods of accounting. One is cash basis, the other is accrual basis. Cash basis records transactions as the cash is paid or as the cash is received. In the accrual basis, you record the transaction when the transaction actually occurs. An easy example to follow is think about a credit card. On a cash basis, you would record a transaction that you put on a credit card when you're actually paying that bill. On the accrual basis, you would record that transaction as you swipe the card, as you create the liability. By using the accrual basis, you can avoid some surprises. So for instance, there are some things that perhaps you get a bill for once a year. In the accrual basis, you would book like 1/12 of that. So for instance, if you have an annual insurance bill, you would book 1/12 of that insurance bill every month as you look at your monthly financial results. So it helps avoid surprises. Okay, there are three basic statements: the balance sheet, the income statement, and the statement of cash flows. We're going to focus on the balance sheet and the income statement primarily tonight. Many software packages will produce a balance sheet and an income statement, but many do not create a statement of cash flows. However, we will talk about cash flows tonight because cash flow is important as well. All right, balance sheet. A balance sheet is a snapshot taken at a moment in time to show the financial condition of your business. So it is as of a certain date. It shows your assets. Assets are the things that you own. It shows liabilities, those things that you owe. And it shows equity, which is what you or your company is worth. A balance sheet, an asset is something of value. So for some typical example of assets would be the cash, your business cash. Accounts receivable, those are amounts that are owed to you that have not yet been paid. If you're in a business that sells product, you would have inventory, so the value of those items that you've purchased that you have not yet sold. Any machinery and equipment that you have in your business. In some businesses, they purchase intellectual property. They might have some patent rights or something that they purchase. That's an asset. Also, if you have land or buildings, those are assets. Those are things that have value. Liability. A liability is a debt. It's something that you owe. So typical liabilities would be your accounts payable, which would be trade. So for instance, if you have inventory or your electric bill or your rent, those are all accounts payable. Loans, so money that you borrowed to help finance your business, that's a liability. And on the accrual basis, we accrue for liabilities, including payroll. So payroll that hasn't been paid. So for instance, if you pay once every 2 weeks, or say you pay once a month, at the end of a accounting period, you may not have all your payroll paid. You would accrue or record the amount that's not yet paid but you actually owe. And then of course taxes. Taxes owed would be a liability. So all of those things are things that you would owe as a business. And then equity, it's what you or your company is worth. So typically it includes the owner's original investment, perhaps any additional investments that they put in over the years, and then the accumulated net income of the business. So the combination of those two things are the equity of your business. All right, so here we have an example of a typical balance sheet. You'll notice at the top, it says statement of assets and liabilities. That's a balance sheet. And it's as of May 31st, 2020. So at that point in time, these were the historical values of the assets and liabilities of that business. So in this case, they've got cash of $20,000, accounts receivable, inventory, machinery, and equipment. All that adds up to $100,000. You'll see that at the total on the left side of the balance sheet. Then on the liabilities and equity, you see your accounts payable, the payroll that's owed but not yet paid, bank debt for borrowings, total liabilities of $28,000, and in this case, the owner invested $50,000, and the accumulated profits from the beginning of time till May 31st, 2020 is $22,000. So their equity is $72,000. Total liabilities and equity equals $100,000. So here's the first thing. If your bookkeeper hands you a balance sheet and that balance sheet assets do not equal total liabilities and equity, go back to him because he's got it wrong. So that's the first thing. All right, income statement. The income statement shows the financial results of the business over a period of time. So unlike the balance sheet is a point in time. The income statement shows your results over a period of time. So typically, an income statement is going to have your sales. They could be cash or credit sales or selling on account. It's going to have cost of sales. Sometimes it's called cost of products sold or cost of goods sold. That's the value of the items that you're selling, that you have sold. And the difference between the two is called gross profit. That gross profit is a margin that is there to cover your expenses. So sales minus cost of sales gives you gross profit. The gross profit then is there to cover your operating expenses, your non-operating expenses, and hopefully give you a profit, net profit. So operating expenses, typical operating expenses could be salary, vehicle expense, if you rent a facility, supplies, repairs, advertising. Those are typical operating expenses. Then you also have non-operating expenses. So there are certain things that you may have in your business that are not, they're either financing costs such as interest, or they're transactions that are not in the primary purpose of your business. In this case, there's a gain on sale of fixed assets. So they had an asset, let's say a vehicle, that they're no longer using. They're not in the business of buying and selling cars, so any gain or loss on the sale of that car would be a non-operating item. Jerry, any questions at this point that you see?
Rich, not yet. So I'll definitely be keeping an eye. But
Okay.
no, as of right now, and everybody, yeah, just as a reminder, if we need to slow down, we have any questions along the way, please get them out there, and we'll make sure we get them answered for you.
Great, thanks. Okay, so here's our example company income statement. This is from January 1st to May 31st, 2020. So it's that 5-month period of time that we're talking about. The sales for this company were $50,000. The cost of those sales, it was either a product or a service, is $30,000, leaving a gross profit, which is the subtraction of the cost of sales against the sales, of $20,000. The operating expenses in this business are salaries. They have rent, advertising, supplies, depreciation, we'll talk about that in a bit, and bad debts. Since we accrue for our amounts owed to us. Sometimes you don't get paid, and on the accrual basis, when you don't get paid and you've exhausted the opportunities to get paid, you might have to write your receivable off, and that's called a bad debt. So the total of all those operating expenses for that 5-month period is $14,500. Subtracted from the gross profit, it gives you an operating profit of $5,500. So the operating profit is the pre-tax profit that is generated in the primary purpose of your business. Then we also had some non-operating expenses here, this being interest expense of $500. So the interest expense, the non-operating expense, is subtracted from your operating profit to give you an income before taxes of $5,000 for that 5-month period. Now you'll also notice that on this income statement schedule, this is the first tool I'll point out to you, is that we've put percentages down, and those percentages are all a percentage of sales. And as you'll see when we talk about it further, understanding those percentages and tracking those percentages will be important to understanding your business.
Hey, Rich, we do have a question.
Yep.
He's asking, is equity the same as retained earnings?
Yes, equity is the same as retained earnings. Retained earnings includes earnings, but there's also the original investment. So your equity is actually your original investments, as well as retained earnings, or the money that you've earned over time. So the total is your equity. But a lot of people will refer to equity as retained earnings, but you have to add your original investment to it. Okay? Any other questions?
That's all at this point.
Okay,
yeah,
good.
Thank you.
Good. All right, so now we're going to talk about some of the tools to get behind the numbers to help you understand your financial statements. So I'm going to talk about 5 different kinds of tools. One is comparisons. The other is ratios, and you should have received a handout that has the definition of some typical ratios. We'll talk about break-even point. We'll talk about critical indicators, or some people call them key performance indicators, KPIs. And again, our focus will be on understanding the results with the objective of future improvement. So I always like to say that understanding your historical results is kind of looking through the rearview mirror. You want to be able to look through the windshield too, but the best way to understand where you're going sometimes is to understand where you've been and to project from there. All right, comparisons. The financial results should never really stand alone. You should compare your assets and liabilities to the prior year end, or perhaps you should also compare your profit and loss or your income statement to either a budget or the same period last year. So let's look at an example. So our balance sheet that we showed you before for 2020, those are the same assets and liabilities and total equity for May 31st, 2020, and we compare it to December 31st, which is the fiscal year end of this business, of 2019. So you'll see, for instance, that the cash at the end of December was $30,000. It's gone down to $20,000. Conversely, receivables have gone up. Inventory has gone up. If you look on the liability side, your accounts payable have gone down. Your bank debt has increased. And you'll note that in the equity section, the accumulated profits have increased by $5,000. If you remember from our income statement, the period ended May 31st, income was $5,000. So that's what the change in the accumulated profits are. So again, you've got a comparison of December to May. So here we're going to talk about cash flow a little bit. So what's happened for the 5 months? Well, if you go back, I mentioned that we've increased our receivables by $10,000. So that's a use of funds, or think about it as something that we have to finance, right? We have to finance those additional receivables. We've increased our inventory by $10,000. So we had to finance the increase in inventory. Now this one's probably a little bit more difficult, but we decreased our payables. So we had to be able to have cash to pay those payables down. So we used $21,000 of our funds over the 5-month period. Well, how do we finance that? What was our source? Well, we made profit of $5,000. Now here, depreciation is a reduction of the purchase price of a fixed asset. So under the accrual basis, you don't expense, say, a truck if you buy a truck in the year that you buy it. If your truck has a 5-year life and the truck costs $5,000, you would depreciate or run $1,000 to expense each year that you have that truck. So since you've already paid for that truck, the depreciation is really an add back to your income that represents cash flow from operations. They've also increased bank debt by $5,000, and they decreased their cash by $10,000. So the sum of those 4 things is $21,000. So that's how they financed the higher balance sheet, if you will, in receivables and inventory and lower payables. Any questions on that? Okay, we'll go ahead. Statement of profit and loss. So remember, I've told you on the P&L, the income statement, you're going to show the same period last year compared to the same period this year. So unlike the balance sheet where you compare it to the end of the fiscal year, on the income statement, you compare the same period. So these are both 5-month income statements. So in this company, this year we did 50,000 in sales. Last year we did 48,000. Our cost of goods sold, or our cost of sales, increased by 2,000. So our gross profit is the same at 20,000. And amazingly for this company, they've been able to control their expenses well, and their total operating expenses are $14,500 for both periods, leading to an operating profit of $5,500 for both periods. And their interest expense was the same for both periods. So the net income for the period ended May 2020 and the period ended May 2019 was $5,000. Now, look at those percentages though. So if you look at it and you say, okay, I made the same amount of money I made last year, that's okay. But if you look at those percentages, you're going to see something. So your sales are up, but your profits are the same. So let's talk about it. So just based on looking at those comparative statements, there's some things that you should note. Cash really has not been managed well. It's likely it's not been managed well. Sales are up slightly, but cash is tied up in your receivables and inventory. So your sales are only up a little bit, but your inventory is up and your receivables up. You had to increase your bank debt to cover the receivables and inventory. And your profit margins, if you look at that income statement, are being squeezed. When I talk about the profit margins, I'm thinking about the percentage. So if we go back, the gross profit percentage for 2020 is 40%. You see that? For the prior year, it was 42%. So your gross profit margin has gone down. And what that indicates is that your margins are being squeezed because your cost as a percentage is rising faster than your prices as a percentage. So without any real sophisticated analysis, you're already learning a little bit about this business. All right, so that was comparisons. Let's talk about ratios. And we'll spend more time on ratios than some of the other things tonight. So some financial figures tell us more when you look at them together. They're called financial ratios. Some examples are debt to equity ratio, current ratio, return on equity, inventory turns or turnover, days sales outstanding, days payables or days account payable outstanding, or working capital days. And we're going to go into each one of these with some definition. It's unlikely that every business is going to need to track all of these ratios. For your business, you need to pick out the ones that are meaningful to your business and to stay on top of them to figure out where your business is going. So let's talk a little bit about some of the ratios. So debt to equity ratio measures how the business is being financed. So you take your total debt as a numerator over the total equity, and whatever that ratio is, that's going to be your debt to equity ratio. So if your debt is equal to your equity, your ratio is 1-to-1. So rule of thumb is that a 1-to-1 ratio is okay. Now your banker is probably going to want it to be stronger than that. He might want to have more equity than debt. When debt is higher, so if your ratio was 2-to-1, that would mean that you have $2 of debt for every dollar of equity. So when your debt is higher, the business becomes more highly leveraged, your borrowing power becomes limited, and your interest expense may increase as a percentage. And it'll become, as your debt's higher, it's going to become more expense too. When equity is much higher, it could be that you might have too much equity in the business and you might need to employ cash somewhere else or invest in something to grow your business. Current assets are assets that are expected to be converted to cash within 1 year. Current liabilities are expected to be paid within 1 year. So in our example company, if you went back, the cash, the accounts receivable, and the inventory were $70,000. Now you'll notice I don't include fixed assets in the current assets because fixed assets are not meant to be turned into cash within 1 year. So the current assets of our business for May 31st, 2020 were $70,000. Our accounts payable was $28,000. So we had trade accounts payable. We had short-term debt. That bank debt was all expected to be paid within 1 year. So that was $28,000. So $70,000 as a numerator and $28,000 as a denominator gives you a ratio of 2.5-to-1. Now 2.5-to-1 is a very good current ratio, generally speaking. A 2-to-1 ratio would indicate that you have twice as many current assets as your current liabilities, which would indicate that you're going to be able to handle your obligations as they come due, because you've got $2 for every $1 of obligation. Return on equity measures what your business is earning on the owner's investment. You can almost think about return on equity as If you had a savings account, what's your interest rate? So if you're earning 10% on your savings account, that would be equivalent to a return on equity. So you're earning 10%. So in our example company, we made $5,000 worth of income for the 5-month period. Now to do a return on equity, you want to annualize the profit, okay, to calculate the return. So if 5 months is 5,000, over a 12-month period, it would be 12,000 if you straight line that. Or in other words, take 12 over 5 times the 5,000. That gives you an annualized profit of 12,000. You take your equity, you have an average of equity. So your beginning equity was 67,000, your ending equity was 72,000. So your average equity is 69,500. $12,000 of annualized profit on an average equity of 69,500 is a 17% return. That's a pretty good return. But remember now, this is a pre-tax return, but a 17% return, generally speaking, is a pretty good return. Inventory turnover. So for those of you that have products that you sell, you probably track those products and put a value on your balance sheet. So one of the measures you measure is inventory turnover. And what that means is how quickly are my products selling. So you'll compare your inventory to your cost of sales. If you think about it, in your income statement, that cost of your inventory as you sell it off goes to the cost of sales or cost of goods sold. So in our example company, our ending inventory was $30,000. Our cost of sales for the 5 months was $30,000. If we annualize that cost of sales, so if we take that 5 months and project it on a straight line basis, it becomes 72,000. So 30,000 goes into 72,000 2.4 times. So what that means is that balance of your inventory, based on what your historical cost of sales are, you're gonna, if you hit that same historical cost of sales, you're gonna have inventory turns of 2.4 times. Now, for most businesses, it's gonna vary, but generally speaking, a 2.4 times turn is poor. You want that inventory to turn faster. You want to purchase it and turn around and sell it. So I'll give you two extreme examples. So if you're building airplanes or ships, your inventory is going to turn slowly because it takes more than a year to produce one of those units. But if you're running a grocery store or some kind of high volume retail, you're going to want that inventory to turn much more quickly. So for instance, a typical grocery store is going to turn their inventory about 24 times a year. What that means is that every 15 days, they've in effect sold everything out of that store. So that's another extreme. But if you're in the business of like the business I was in, selling technology products through distribution, we'd be looking for turns of 6 to 8 times a year. But each business is going to be different. Days sales outstanding. It measures the quality of your accounts receivable. So in our example company at May 31st, 2020, the receivable balance was $20,000. Our sales, now remember, receivables are generated from what you've sold, so you would use your sales for the 5 months. You'd annualize those sales, or in this case, I'm showing it in a different way. I'm sorry. You figure out what your daily sales are. Think of it this way: to get your day sales outstanding, figure out what your daily sales are. So in the 5-month period, there's 151 calendar days. $50,000 divided by 151 means that your daily sales, your average daily sales, were $331. If you divide that $331 into 20,000, you're going to come up with 60 days outstanding. So what that means is in your receivables, on average, it's taking you 60 days to collect. If your terms of sales are 30 days, and you have a 60 days outstanding number, your collections need to be improved, or you've got some other problems going on in your receivables. If you go back to the December 31st, 2019, the DSO number, the days sales outstanding, came out to be 31. So if we assume that our example company has 30-day terms, 31 days outstanding is very good. Days payable outstanding, also known as DPO. It measures the average days before you pay your vendors. So in our example company, our accounts payable is $5,000 at May 31st. The cost of sales, now remember accounts payable, you'd be paying for your inventory and frankly for some other expenses, but your cost of sales was $30,000. If we figure out the daily average cost of sales, it's $199 a day, into $5,000, says that you have 25 days of accounts payable outstanding. If the terms of sale from your vendors are 30 days, this 25 days may indicate that you are paying early. You may want to pay a little bit slower because vendor payables are really interest-free loans if you think about it. But be careful, if you pay late, it can impact your relationship with the vendor. So what I recommend to folks is once you negotiate your terms, follow your terms, but unless there's a reason to pay early, I would normally pay within terms so that I'm using my vendor's money instead of having to go out and borrow from a bank. Working capital days. Working capital days measures the purchase to cash efficiency. So what I'm talking about is from the time that you purchase inventory or you purchase your services and you turn it into a sale and then that sale turns into cash, that's what we're measuring here. So we would look at days sales outstanding, we'd look at the receivables, we'd look at inventory days. If you're carrying inventory, we'd figure out what your days of inventory are, and in that ratio sheet I handed you, I think we've got inventory days as a formula. And then you would subtract from it the days payable outstanding. So in our example company, if we take those three numbers and combine them, there's 185 working capital days as of May 31st, 2020. So what that's saying is it's taken 185 days from the day that you purchase inventory or you purchase a service to turn it into a sale and get that cash for that sale. It's 185 days. So you've got to anticipate financing that. At December 31st, 2019, your working capital days are 106 days. So what we're seeing here by looking at the working capital days is that we have to finance almost 80 more days worth of working capital because our balances have increased. It could be that we have a problem managing our working capital. All right, so I've handed out, let's see how we, oops, sorry. I've handed out an Excel spreadsheet, and Jerry, I might need you here. Oh, sorry, let me get the spreadsheet up. There we go. Okay. All right, so you should have a copy of this, but I've put this up for you to take a look at. What we have here are ratios for a business. And you'll see that on the left side, it's January 19, 2019, and we've tracked it for the entire fiscal year and then into the next 3 months of 2020. So in this case, days sales outstanding or inventory days go from 30, in June it's 36, in October it's 40, in December it's 42, and in March it's 40. So the question I've got, and I'd like you just to send it in on chat, is this trend a good trend or a bad trend? Okay. So go ahead and send that in on your chat.
Rich, most of the participants are agreeing that it's a bad trend.
That's correct. So what's happening is your receivable days are going up. And remember, we're basing it on recent sales. So it's not that the sales are increasing significantly. It's based on recent sales. So that ratio is an indication of how quickly you're collecting your receivables. So that trend is a bad trend. Now, does that mean that it's a problem with your collection department, that they're not doing a good job? Well, perhaps, but it also may be an indication that there was a problem with some of the things that you've been shipping or some of the services that you've been selling. Maybe there's some problems where the customers are coming back and saying, this wasn't right. This product wasn't right. The service wasn't right. Or perhaps you're invoicing incorrectly for them. You're not giving them the right information, or you haven't invoiced in the way that you've agreed, and it's slowing down your payments. So sometimes the DSO may not be an indication of bad collections because you're not staying on top of it. It may be an indication of the quality of your product or service, or the quality of the information that you're sending to your customer. So you would need to get behind the number to understand why it's going up, and then to fix the problem that's causing it to go up. Now, days payable outstanding, here we go. We started at 20. By the end of July, we're at 20. But then in December, we're up to 30. And in March, we're up to 30. So is this a good trend or a bad trend?
Okay, we've got agreement that it's a good trend.
Okay, that's great. That's great. So as long as your payment terms are 30 days, or maybe even more, that's a good trend. Because again, remember, that's when you're using your vendor's money in accordance with terms, that's cheaper than going out and borrowing from the bank. Okay, gross profit margin. I expect this will be easier for folks because more folks are familiar with it, but we've gone from 40%, we started working our way up to about 43%, but by the time we get to March 2020, we're at 37%. So is that a good trend or a bad trend? All right, so I'll interject here. It was a good trend during the year while it was going up to 43%, but now suddenly in 2020, it's gone down. So what we need to understand is, why is it going down? Is it that our vendors raised the product cost and we didn't raise our prices enough? Because remember, if our vendor raises the price, we need to raise our selling price in the same ratio. So if a vendor raises a price by $2, raising your selling price by $2 is not going to be enough. If your margin is 50% and your vendor raises the price by $2, you need to raise your selling price by $4 if you can get that from your customer. It also could be an indication that if you have multiple products, that you're selling some products that might be lower margin. So you want to get into understanding why that ratio has gone down, why that margin's gone down, and understand why. If it's because the vendors have raised prices and you've not been able to raise your prices enough, that's one issue. If it's the fact that you're selling some products with lower margins, you might want to address what products you're selling and look at the prices of those products, or try to promote products with higher margins. So operating profit was running 7 to 8%, but then since July 2019, it's been steadily going down to the point now where we have a negative operating profit. So good or bad?
I think everybody agrees that's bad.
Okay, so if this operating profit is indicative of this business, if you look at the gross profit margin in January of 2019 was 40%. and it went down to 37% by March of 2020. So that's gone down 3 points. So if it was only a gross profit margin problem, your operating profit would have only gone down by 3 points, but your operating profit's gone down by a full 8 points. So not only do you have some issues with your gross profit margin, but this would indicate that you've got an issue in your operating expenses. Okay, understand? Okay. And you'll notice the key here is looking at the trend. It's not so much the number itself, although you may get some benchmarks from competitors if you have access to that. But if you don't have benchmark from competitors, just simply tracking your ratios and looking at the trend and understanding the change of the trend is helpful in running your business. Oh, we went to the wrong one, sorry. There we go. Okay. All right, any questions on ratios? Because we're going to talk about break-even point now.
Yeah, Rich, hold on one second. We
Yeah.
do have a question in the Q&A here. It's from Lori, and she's asking, what would include in the operating profits? Not sure I quite could you elaborate on that question just a little bit, Lori? As written, it said, what would include in the operating profits?
Maybe
perhaps, Rich, maybe just
maybe
a little
if
bit
I go back,
calculate it.
let me go back to the income statement and show you.
Yeah.
All right, so on the income statement, you'll notice near the bottom, there's a line called operating profit. So after operating expenses, it's operating profit. So what that number is, it's your gross profit minus your operating expenses. So it's the margin or the yield that you've gotten from selling your goods and services, which is your gross profit, minus those expenses to help run your business. So that is your operating profit. So the profits for the product or service that you're selling are generating a pre-tax operating profit in this example of $5,500. Does that help?
Rich, I think that's great. I think that's what she was looking for, just to determine how that, where that comes from. Thank you.
Okay, let's see. Okay, so we've talked about comparisons. We've talked about ratios. Now we're going to talk briefly about break-even point. Now, every business has some costs that are fixed costs, also known as sunk costs, and some costs that are variable or incremental. Fixed costs for your business could be your rent. It could be your payroll if you have a set number of employees. It could be your annual insurance bill. Your variable cost could be, if you're selling a product, your inventory cost. So every time you sell a unit, you're going to have inventory cost associated with that. And if you pay a sales commission based on sales, that's a variable cost. So a fixed cost is going to be there just when you turn the key to open the door in the morning. Okay, that fixed cost is going to be there. A variable cost is going to be a cost that is incremented based upon the volume of your business. So what we do is we do what's called a break-even analysis. It's going to tell you during a period of time what volume you're going to need to go from losing money to making money. And I'm going to show you a graphic example of that here. So in this case, this company has products that sell for $15. The variable cost of the product, which could be let's say, your cost of sales, the cost of the inventory or service, or it could also include a sales commission. So if you're paying 10% on sales for sales commission, that would be a variable cost. So you subtract your variable cost from your selling price and you come up with a variable margin. In this case, 35% or $5.20 a unit. But 35% is your variable margin. In this example, our business has fixed cost for this period of time of $10,000. And that could be for your rent. It could be for your salary if you've got a fixed salary. It could be basically your utilities run the same thing. So the cost that you're going to have once you open the key to that door in the morning for that month or for that year is going to be $10,000. So if we know we've got fixed cost of $10,000 and we know we've got variable margin that comes to 35%, we can calculate the break-even sales number by taking our fixed cost and divide it by that variable margin of 35%. And what that tells us is we need to sell $28,571 worth of product to break even. So if all of our product is $15, what that tells me is we have to sell 1,905 units to cover our fixed costs. Once we hit our fixed cost, we're going to be generating income. We're going to be generating positive net income, as you can see by the graph. So once we got past that 28,571, we start to make a profit. Okay? It's always good to have knowledge of what your break-even point is for your business. Any questions on break-even? I'm not going to spend a lot of time on it. It's actually something that is a little bit complicated. If you've got a bookkeeper, you can, or an accountant, you can ask them to tell you what the fixed costs are and what your variable costs are to calculate your break-even. In a lot of businesses, it's simply going to be your gross profit margin is going to be your variable margin. But there may be some other expenses that are variable. If you pay people bonuses based on sales, or you pay them based upon profits or things like that, those are also variable costs. So, Jerry, do we have any questions on break even?
Rich, no questions. A comment just saying that they're thanking. It was a great clarification. I do have a comment also for any of the entrepreneurs that are perhaps watching this that aren't in business yet, but preparing to or planning on launching a business. This type of analysis using your estimates and your pro forma type information is very important in terms of trying to determine where that break-even point is. And I like the way that Rich described that, not only as a dollar amount, but as a unit of sales. So if you're a baker, you know, how many cookies are you selling? Or if you're in a service industry, how many hours are you billing? Really quantifying that in a way that makes sense to you as an entrepreneur to look at that and really take a realistic step back and say, oh, gee, I need to actually sell this many of this item to break even every month. And sometimes it's very eye-opening for the prospective business owner to realize, you know, what that number may be. Usually it's a little bit higher than they think, but it gives you a good perspective before you get into things as to, you know, what the expectation would be. Because if you're not at that break-even point, then obviously you're going to be losing money. Yeah, but yeah, that's great, Rich. Thank you.
Yeah, you want to make sure that you've got the resources there to get those sales too. So if you're out there selling a product or a service, you want to make sure you've got the capacity to generate those kind of sales. Because if you don't have the capacity, you know you're not going to hit your break even. Then, you know, it's going to be a problem, an ongoing problem for you.
Rich, there's one more, and I think you described it a little bit, but maybe just another minute on just that difference between fixed and variable, and what types of things would they be able to consider as a variable expense? I know you mentioned a few. I don't know if you have any further to elaborate on that.
Yeah, well, first of all, the thing that you're going to want to do is you're going to say, okay, over what period of time? And generally speaking, people will look at break even over a 1-year period. So what you look at is, and when you're doing your budgeting, you might be able to figure out what's fixed and variable just by the way that you're doing your budgeting too. But generally speaking, for instance, if you've got a factory and you pay people based upon piecework, they get more money if they produce more pieces, that would actually be variable. But if you pay somebody a salary, no matter what they come up with, that would be a fixed cost. If you've got machinery and equipment, that is, generally speaking, the way it's expensed, it's going to be a fixed cost. The cost of the facility you're in is going to be a fixed cost. Things that are not as clear, and this is where maybe you'd ask your accountant, it could be like your travel and entertainment expense. A lot of times those numbers may vary, but generally speaking, that travel and entertainment is not going to go up or down based upon your sales. It's going to really be based more upon other efforts. So when I look at it, I look at travel and entertainment expense generally as a fixed cost, unless I have a separate group that is doing just sales, and that is, the more they travel, the more they sell. But look at it over a 1-year period of time, what goes up or down based upon the volumes of your business, and what's going to be there no matter what. Does that help, Jerry?
Yeah, that's great, Rich. Thank you.
Okay. All right. Critical indicators, KPIs, key performance indicators. A lot of people call them KPIs. So not all your management information is going to come from your accounting system. Not everything that you see on a balance sheet or an income statement is going to be crucial for the management of your business. There are indicators that'll tell you how you're doing on a daily or weekly basis. We just talked about this first one, this first example, units sold. If we did a break even and we know that we have to have 1,900 units sold a month, a key performance indicator may be the number of units sold and tracking those during the month. And then when you look at those units sold, you might be able to look at a trend. I know in the businesses that I've been in, the last week of the month was usually the heavier volume. We used to get close to 50% of our volume in the last week of the month. But I knew what that trend was, and I could look at my daily sales trend or my units sold trend during the month and have a sense of whether or not I was going to come up with my number that I had projected for the month. Another example of a critical indicator could be billable hours. So if you're billing for services, if you're in a services business, Jerry and I were talking before this about an accounting business, an attorney, billable hours is a critical indicator for them. If you do a services business where you send people out to do services or you do repair services, billable hours could be a crucial indicator. Backlog of unfilled orders. Backlog represents those things that you've got orders on that you have not yet sold. So as the backlog goes up, that would be a critical indicator. You want to know why the backlog's going up. Hopefully it's going up because you've got increased volume and it's not because your factory or your services are slowing down, but you want to track your backlog. If you're in some kind of catering business or something like that, meals served. If you're in a business that's highly e-commerce oriented, sometimes based upon the website hits, we get a sense of what our future sales are going to be. And what you want to do is you want to track these indicators over a sensible period of time. It may be daily, it may be weekly, some indicators may be monthly. But the key indicators, in addition to some of those financial ratios and the financial statements, can be very useful. Now I'm gonna leave it open to the group. What might some key indicators, I don't know what businesses, normally when we do this in person, I'll know what businesses you're all in, but perhaps you might indicate on the chat what business you're in and what kind of key indicator you might think of, and maybe we can talk about some of those.
Okay, Rich, we have one. It's a child care center.
Okay. So for a child care center, it may be simply the number of children, or it could be the number of hours if your billings are based upon hours. Another indicator may be a student-teacher ratio. right? So do you have the proper number of employees for that business? So it would be a participant or student teacher ratio might be a crucial indicator for you. It depends upon what's really crucial in making your business successful. So if it's key in a daycare business to have a lot of attention, and you're charging a premium to cover that attention, you may want to have a low student teacher ratio, if you will. Or if it's one where that's not crucial, you might want to improve that student teacher ratio, as in more students, fewer teachers. Okay, any others out there?
Rich, we have another service, a interior design business.
Okay, interior design. Did they indicate anything that they thought might be crucial? I would think interior design, it might be backlog, might be a crucial indicator of what you've got out there in terms of future sales, which would either focus you on production and manpower to get those things done, or maybe you need to spend a little bit more time marketing. I don't know, I've never worked with an interior design, but I would think backlog would be an important ratio.
Yeah, I think you're right. My wife is actually in that business, and it's managing, as you said, but also as most typical businesses, it would be hours. And if you happen to be, both a service business on the design side and selling product, in terms of furniture or accessories and that kind of thing, then you would have the type of metrics that Rich was talking about from a sales point of view. How many dollars of product sales are you doing per month, and that kind of thing. Those could all be monitored.
Yeah, in that case, you'll actually probably want to track the product sales within your system, so that you can track those separately from your billable hours for design services.
Great. And very similar, it would be a photography business.
Yeah, and I'm actually working on some wedding planning for my daughter right now. It could also be tracking the percentage of some of the products, because I noticed that they have different packages, and how often do you upsell versus selling the base package, that kind of thing might be an important thing to track. Also, again, hours or number of customers, that kind of thing. Any other ideas, questions?
I think you covered the respondents, Rich. That's great.
Okay,
And as Rich said, it's really right in that name, that critical indicators for each business owner to think about. What are the things that are truly critical for your business, and also, as Rich said, it may not be coming right from the financial statements, and typically it's the way that the business owner thinks about their operation in terms of how they measure things. So it may not be directly financial, but you'll find that it turns into it, especially as Rich alluded to as he went through the previous part of the presentation. So give that some thought, everybody. That's an important one.
And one of the things to think about too is the indicator that's the earliest indicator, if you will, for sales might be more critical than some of the historical indicators. So when I mentioned website visits, if you have a sense of, if I get 100 clicks on my website, that on average turns into 3 sales, which in turn is going to generate this much business for me. Well, if you track the clicks, that's going to be before you actually get the orders. So it's going to be an earlier indicator of how your business is doing. So key performance indicators, the earlier in the process you see it be effective, sometimes the more meaningful the measurement. Okay? All right, let's move on here. All right, let's talk about managing earnings. Okay, so now we've got the tools. We've got comparisons, we've got ratios, we've got break even, and we've got performance indicators. Okay? Use the ratios and the break even And knowledge of your competitor if you've got that kind of information to determine your sales prices. Perhaps you'll look at volume discounts for bundling or promotional bundles, or if you can add complementary products that your structure allows you to add, that might help you improve your profitability. Consider making costs variable rather than fixed. Now, sometimes this is counter to what people think, because they'll say, well, if I pay sales commissions, the sales guy, if he has a big month, he's going to make a lot of money. Well, yeah, but if he does, you should be making a lot of money too, because you got more sales. If you pay folks on your staff with bonus plans rather than all base salary, that can be helpful. It gives them an incentive to help improve the business, but it also gives you a lower break even. So if you pay, if you've got, say you've got a manager in your business, and that manager should make $100,000 a year. If you can get that manager to work for a base salary of say $60,000 and give them a bonus plan that if they hit all their numbers, they actually make a little, make $100,000 or make a little more than $100,000, maybe $110,000. What that does is it's going to improve if that bonus continues with better performance to get more sales and more profits, that they're going to be working along with you to improve your business. But if times turn bad, if you have a COVID happen and your sales fall off, it lowers your break even, because you're only going to be paying that guy $60,000 as opposed to the $100,000. So look at some of the costs and determine whether or not it makes sense to use a variable cost system, either sales commissions, bonus plans, that kind of thing, versus all fixed. Many businesses are good at controlling their operating costs. So they're looking at that income statement and saying, oh, my gross margin's up, my gross margin's down, my operating expenses are up, but they don't focus on necessarily controlling their working capital. I've seen this a lot. The amount of net working capital that your business has impacts your return on investment. So think about that for a minute. So if you're invested in receivables and inventory and have very low account payable number, you're investing a lot in your business. And if your sales aren't significant to cover that working capital, it could actually limit your ability to grow, because you got to generate cash to grow. So managing working capital is crucial. If you go back and remember those ratios, if your receivables are going from 30 days to 45 days, you now have to go out and finance that extra 15 days worth of receivables. And that takes away from your ability to borrow money to maybe put in a new product line. So managing your working capital as well as managing your operating margins is crucial for a successful business. All right, so let's talk about some examples of how to manage your working capital. So here's some customer related ones. If you've got a business that gets large orders, is it possible to get a deposit on order? Another thing to think about is if you've got electronic orders, get folks to prepay or pay upon shipment. That does two things. It accelerates your cash, but it also eliminates your bad debt risk. So if you're not carrying a receivable because you got paid at the time of shipment or before shipment, you're not going to have a bad debt. In the construction business, and I don't know if we've got anybody on the line here that's in the construction business, but they have a concept of pay when paid. So all their subcontractors don't get paid until they get paid by their customer. So if there are problems with what the subcontractors did in terms of quality, and that the the manager of the construction, the person who's having the construction done delays payment, that impacts the vendor. So they have a concept of pay when paid in the construction business. In the software business, in the government business, in businesses where you have long projects, look for milestone payments, including an upfront deposit. What you want to do, if you can, is gain the payment of your cost before your final delivery. So if you think about it this way, if your gross profit margin is 50%, it would be great if you could get 50% of your sales price paid to you before you actually ship, because you financed your entire cost of sales. Okay? In a service business, one of the things I used to be also in the copier business. And one of the biggest things we had in the copier business was our service business. And in the service business, what we strove to do was to have service contracts where we would get a recurring monthly billing. If we have recurring monthly billing, one of the things we would consider, and you'll see this too, I don't know how many people have lawn maintenance service and that kind of thing. They will give you a discount if you pay the entire year up front. In the services business, a recurring monthly billing, I might be able to finance that, or I might give a discount for somebody to pay up front. So I'd get, in effect, free financing, and I'd eliminate my bad debt exposure by doing that. Okay, so that's customer related. Vendor related. Now this is something a lot of people, especially smaller businesses, don't think about because they don't think they have leverage with the vendor. Try to negotiate extended terms or better terms with your vendor. A smaller business, if your vendor is coming up with an increase that seems significant and you can't get them to lower that increase, see if you can get them to give you extended terms. So if you're normally paying in 30 days, and let's say somebody raised your prices by 5%, and that's a big increase in your business, and you can't get them to lower that price. Sometimes you might be able to negotiate extended terms for your payment. If you can do that, remember that in effect is free financing. You don't have to pay interest on extended terms. But if you do negotiate extended terms, here's something to think about. Make sure that you get your credit limit increased by that vendor. I can't tell you how many times I gave people extended terms in the past, but they had a credit limit that once they utilized their extended terms, they hit their credit limit. And because I was their sole source for product, they still ended up paying me in 30 days instead of 45. The other thing that, from a vendor related thing, just what I'm talking about right now, if you have the ability to get multiple vendors for the same product, see if you can do that, because that'll give you a higher combined credit limit, and you might be able to use the other vendor as a negotiating tool when negotiating with the vendors. So you got two vendors, you can negotiate with both of them, saying, well, I'm gonna give more of my business to the other guy, or he's giving me better terms. Okay. Another thing is if you've got vendors, one of the things I used to do is I actually did credit checks on my vendors, because if my vendor was not financially viable, I might get my product cut off, and if it was my only vendor, I was in deep trouble. So if you've got multiple vendors, that gives you a bit of safety if there's a problem with one of your vendors, if they've got a credit problem or if they've got a manufacturing problem. Okay, another thing to think about for managing your working capital, lease versus buy. Think about whether you want to rent something as opposed to buying something. Here's something that a lot of folks want to own the facility that they're in. Sometimes that's not necessarily the best answer for you, is to own the facility, especially if your volumes go up and down. So look at rentals as being a way to not commit your working capital beyond the rent. So instead of buying something, look at renting something. All right. So now we talked about managing working capital. So we talked about comparisons. We talked about ratios. We talked about break even, key performance indicators. Now here's some basic rules for record keeping. And this is especially small business, single owner business. Rule number 1, keep your business cash and credit separate from your personal cash. Look at number 2. Don't fool yourself. Keep those things separate. Keep record keeping simple, timely, and accurate. When it comes to your financial statements, these ratios, this analysis that I'm suggesting that you do, if your financial statements are old, if you're just now looking at your March financial statements and you're looking at your day sales outstanding, you're looking at your margins, you're looking at even key performance indicators based on history, that stuff is old already. You want to keep your record keeping on a timely basis so that you can analyze the most current information and make good decisions going forward. Always keep a dashboard of your key ratios, your KPIs that you review frequently. One thing if you've got KPIs that you get, sometimes the first thing in the morning you look at your KPIs, or the last thing at the end of the day you look at your KPIs. 5, don't try to go it alone. If you're not an accountant, if you're not a lawyer, if you can afford that, hire that help. You don't need to have full-time help. You can get part-time help for accounting or part-time legal help. Number 6, and this is crucial, always pay Uncle Sam on time. And when I say paying Uncle Sam, it's not only your income taxes, but more importantly, if you've got payroll, pay those payroll taxes on time. Do not mess around with not paying payroll taxes on time, because they will move quickly on you. So pay Uncle Sam on time. And if possible, number 7, try to have a cash reserve for contingencies or business downturns. Sometimes businesses that are profitable may fail due to lack of cash. One of the things we learned in SCORE was, of new business failures, the initial failure rate for the first 18 months is pretty high, but then the next highest failure rate really comes around, excuse me, year 4 or year 5. And a lot of times, those are people that are profitable businesses. They may have pulled money out of that business. Maybe they decided to get that boat or that luxury car or buy that second home, and they've left their business with too little runway in terms of having cash available. So try to have a reserve, either reserve in cash or access to cash to cover your downturns. Okay, any questions?
No, I think we're good right now, Rich.
Okay, so I think, so you've got all these slides, you've got the financial ratio handouts that I've given you, you've got my phone number or my email in case you have additional questions. I think, Jerry, you might have some survey information.
I do. I'm going to launch the poll now. If everybody could take a moment just to go through this. I think it's only like, I think it's less than 10 questions, if I remember correctly. Yeah, it's 10. It's really quick, multiple choice. We're just trying to get some feedback so that we can improve our workshops as we go along and make sure that we're providing the best quality. I just wanted to take a moment to thank Rich for his time tonight. You guys are just truly lucky to have him to go over this material. He's got a lot of experience, and as you could see, there was a lot to cover in a short amount of time. So keep in mind that SCORE is here, and that if you guys need additional help as you go through this, if you have questions, if you'd like to have a mentor, just go over to the website, the piedmont.score.org, and go ahead and click on the link to request a mentor. We'd be happy to help you out. Thanks, everybody, and look forward to seeing your poll responses. We'll stay online for another couple minutes. If anybody has questions, put them in the queue, and I will shoot them over to Rich.
Thank you.
Oops, hold on. There we go. Sorry, guys. I thought I had the poll launch, but it should be in front of you now. Got a question asking about the copy of the slides and the spreadsheets. I think we sent that out earlier, but what we can do is we can do another follow up and make sure that anybody that missed that will get a copy of that as well. And we did record this session tonight, so we do have a brand new YouTube channel. So once this is all ready and prepared, later on this week, recording should be available over there at Piedmont Score under at YouTube. Rich, we got a question. If you're still there, she's just asking if there's a particular time frame for purchasing equipment for a business. Jennifer, maybe you can clarify what you're asking there in terms of time frame. Okay, she did clarify. She said she bought it a couple of weeks ago, and is it something that can still be incorporated? Maybe she's asking in terms of something that was previously purchased that is now used in the business as a business expense, so part of the startup capital, perhaps, Rich?
Yeah, if it's an asset that you're going to end up as a fixed asset, a contribution of the value of that asset can be part of your investment in the business and becomes part of your equity. So if you're going to contribute that or in effect donate that to the business, the value of that, the fair market value at the time that you donate that to the business would be what you'd book it as an asset. And then the offset to that would be your investment in the business. Mm-hmm. And then, of course, we talked about depreciation. You would then depreciate that asset over its remaining life. I hope that helps.
That's exactly what she's asking. Okay, so for the fair market value, you could probably maybe even something like eBay, you may be able to find a little bit of a value in terms of something that's similar that's out there. And then I think you would probably be relying on your accountant to help you with the depreciation of it.
Yeah, I think the fair market value, though, should not be greater than, and I may be wrong on this, if it's a typical piece of equipment, it was recently purchased, the fair market value shouldn't be more than what you paid for it.
Mm-hmm.
Now, if you were donating real estate or a building, that might be different. But if it's a piece of equipment that you're donating, so for instance, if you take your automobile and you've decided your automobile is now going to be used strictly for business and you're going to donate it to the business, the fair market value of that automobile is clearly going to be less than the day you bought it.
Okay, I think we got to all the questions. And again, thank you everybody for participating tonight. I hope everybody got some value out of this. And I think you must have. It was a very, very nice presentation, and some great information conveyed. And everybody have a great night. And again, if you have any questions, please reach out to SCORE. We'll be happy to help. Thank you.